Hi, I'm Ross from Coombsmith 150 Group Property Accountants, and we're just going to look at its structure. What's your structure like? Is there simple things you can do? And looking at something a little bit different today, rather than concentrating on the tax or things like that, we're just looking at simplifying things. Looking, can we make your life easier? So in this case, we have got my favorite example, Joe King. So Joe and Sue King, they've got two rentals and maybe LTC, ABC Limited. Joe owns 100%. They've got two rentals and a second LTC, XYZ Limited, 50-50. And Joe's actually got a rental in his personal name. So with this, looking at the overall structure, first thing I would normally look at is trust and asset protection. Do they need that? So we would go through a discussion with that. Do they really need a trust? And a trust is a real pain, but it's sometimes really important for asset protection. So we'd look, is personal names right, or should it be a trust? Then we'd look in this case, do we need all three entities, or is there a way that we can simplify it? So in this case, it's actually a recent client that I've met with. We're actually getting rid of this. We're getting rid of this. And we're trying to do it all at the 1st of April. So we're basically, these two rentals are going to move across into here. This rental is going to move up here. And yeah, we're all looking at doing it, trying to get it in place at the 1st of April so it aligns with the tax year. So at the moment, this person has got um, three sets of accounts that they need to do, or their old accountant at the moment is doing. So there's three lots of costs. If we can simplify this down to one, we're going to have one bank account, one entity to worry about, and one set of accounts or one accounting cost. Yeah, it's not going to be quite a third of the costs, but it's going to get down towards that. So it's really going to simplify things for the clients. So that's just little things that we look at. Obviously, some big things in this. The first one is, yeah, looking at trust asset protection, is that needed? Second, looking at what is the tax consequences for this. So we've actually managed to do this in a real clever way where there is no bright line, there is no taxable sale, there is no bright line restarting. Yeah, there is no loss of interest deductibility. It all carries on the same way. So sometimes we can do these sort of things in a real smart way without any negative tax consequences. And the last thing that we're still going through is just checking the cost versus the benefit. If this was going to cost $50,000 to do, well, obviously there's no way, it doesn't make sense. But we're probably looking at saving $2,000 or $3,000 a year. That quickly adds up. And yeah, most likely our legal costs through a lawyer changing this around is most likely actually going to be caught up pretty quick in a year or two, making this really worthwhile. So yeah, just different things to look at. With the moment you're losing interest deductibility, interest rates are going up, worth just re-looking at your structure. Is it set up in the best way? Do you have the profit going through to the lowest income earner? Yeah, do you have unnecessary entities that you don't really need? Do you have properties that aren't performing? So effectively, could you sell something, replace it with something better, ended up with a lot better cash flow and a lot better capital gain and things long term, or added value opportunities? So yeah, hopefully you've got something from that and enjoy that. Thanks a lot. Bye.